This is Dr. J. Sathya, Associate Professor of Economics, Sri Sharda College for Women, Salem 16. The topic we are going to discuss today is nature and the scope of macroeconomics. Economics has been broadly divided into two areas, which is microeconomics and macroeconomics. First, let us see the definition for economics. Economics is the study of mankind in the ordinary business of life. It examines that part of individual and social action which is most closely connected with the attainment and with the use of the material requisites of well-being. The term micro and macroeconomics has been coined by an economist, Ragnar Frisch, in the year 1933. Macroeconomics is the study of ordinary business of life in the aggregates. That is, it studies the behavior of the economy as a whole. It is the study of key variables, namely total output in the economy, level of employment, level of unemployment, aggregate price level, and national income. Therefore, the subject matter of macroeconomics covers the rate of growth of output, changes in the level of employment, changes in the level of unemployment during the period of recession and boom, appreciation and depreciation of foreign exchange rates. Before Keynes, all the economic theories have been discussed with microanalysis. Only after Keynes, macroeconomics has gained its importance. Only after the publication of the Keynes General Theory of Employment or the Employment Theory, the macroeconomics has gained its importance. So macroeconomics has also been pointed out as Keynesian economics. Keynes may be described as the father of macroeconomics. Now let us see the relationship between micro and macroeconomics. First, the term macro is of Greek origin, which means large. Macroeconomic theory is explaining the working of the economy as a whole. It is the study of the key variables like total output, employment, unemployment, price level, etc. So it is the study of the economics of aggregates. Whereas micro means small. Microeconomics studies in a selective manner, not an aggregative one. It explains the working of the markets of individual commodities and the behavior of individual buyer and individual seller. And macroeconomics is a study of aggregates like output, employment, etc. It uses the principle of aggregation. Whereas microeconomics is a study of the behavior of individual firms and determining the price for individual commodity. It assumes other things remaining the same, that is ceteris paribus. In macroeconomics, we use general equilibrium analysis by assuming interdependence between the prices and outputs of all goods. In microeconomics, we use partial equilibrium analysis by assuming other things remaining the same, that is ceteris paribus. In macroeconomics, the feedback effects cannot be ignored. For example, if a number of workers who are employed in a particular industry is increasing, that means their wage level will increase, their income will increase. As a result, their consumption will be more. When the consumption is more, again, that will have a multiplier effect, which tended to increase the production, national income, etc. This feedback effect has been considered in macroeconomics, whereas in microeconomics, these feedback effects are ignored. Simply, we start with the view that the number of workers employed in a particular industry increases. That would mean higher income, which enable them to spend more. So microeconomics has totally ignored the feedback effect. In macroeconomics, we are using the lumping approach. That is, we are studying the economy as a whole. Whereas in microeconomics, we are using slicing approach. That is, we study the economics in small sections. In microeconomics, we study the small section of the economic system. Then we try to generalize them from the subsystems to the system by using the mathematical inference. Therefore, in microeconomics, the approach we have used is slicing, and in macroeconomics, we are using the lumping approach. That is, we are dividing the whole system into huge chunks and study the relationship among these aggregates. But both the methods have their value. The method of microeconomics are more elegant, but it is difficult to get any tangible results from them. But the macroeconomics, the methods seems to be more crude, but they yield important results. Now let us see the interdependence between micro and macroeconomics. Both micro and macroeconomics are not opposed to each other. They may be described as the two branches of economics. There exists the strong interdependence between the two, that is micro and macroeconomics. The tools of microeconomics is helpful to understand the wide range of problems relating to the whole economy. For example, the psychological law of consumption, which is a macro theory. This is again based upon the behavior of the individual consumers. Therefore, the macro theory is based on the theories of the individual behavior. Microeconomics is also making a positive contribution to macroeconomics in another way. For example, if we want to control inflation, a macro term, we are supposed to control the cost of production by reducing the cost of raw materials, wages, etc. And the production of the individual firms should also be increased by increasing their productivity. These are all the micro level issues. So again, if we want to control the macro problem, we are supposed to use the micro issues. Then microeconomics is providing a strong foundation to the macroeconomic theories. For example, if we want to study the rate of interest profits in microeconomics, the macroeconomics tells us the aggregate saving, aggregate investment, which will determine the rate of interest. So, there exists the strong interdependence between micro and macroeconomics. The relationship between the two is like a two-way street. Now, let us see the limitations of macroeconomics. The first limitation is the method of aggregation. If we want to aggregate the variables, there should be the homogeneity among the individual units in order to make them up as a whole. But this assumption is an unrealistic one. There are some differences among the goods that makes it difficult to bring them under the common measure. For example, individual A requires 2 apples and individual B needs 2 apples. So we can make a meaningful aggregation here as 4 apples are required by both of them. In similar way, A requires 2 apples and B is requiring 2 mangoes. Again, still we can make an aggregate assumption that there exists the total demand for 4 fruits. But if we consider the demand for the heterogeneous variety of foods, for example, A is demanding for fruits, and B is having a demand for pins, and C is having a demand for tables, shoes, cars, etc. In such a problem, we cannot make a meaningful aggregation. Then the next criticism is fallacy of composition. That means we cannot simply assume that what is true for individual need not be true for the economy as a whole. For example, as an individual, if we save more amount of money, we can prosper. But if the economy as a whole, all the people have started saving, what will be the effect? The consumption will fall. When the savings are more, consumption will be reduced. As a result, production will fall and the entire economy will get affected. So what is true for individual need not be true for the economy as a whole. And the next limitation is aggregates do not tell us much. For example, if we want to compare the national income between the different countries, that does not tell us much. For example, both price level between the countries may be different. The size of population may also be different between the two countries. Their standard of living may be different. But we simply say that the national income between the two countries is same. But these issues like standard of living, size of population, price level, there exists a difference in these issues. Then, macroeconomic approach may overlook some interesting features of the small units. It may overlook some interesting features of the small unit. For example, the whole industry may be undergoing a boom, but few industries may face recession. That may be overlooked when we consider the economy as a whole. Then in macroeconomics, there is no possibility of making accurate measurement. Since the macroeconomics is based only on the aggregates and averages, accurate measurement is impossible in macroeconomics. Then another limitation is there is a danger of making misleading conclusion in macroeconomics due to the neutralization of the effects. For example, in one sector, the price level may be increasing. In another sector, the price level is falling. These two forces may get neutralized and we may get the result that the price level is neutral. There is no change in the price level. So this type of danger of misleading conclusion is possible in macroeconomics. Now let us see the importance of macroeconomics. Of course, macroeconomics is the study of the entire economy. It has a vast scope. There are innumerable interrelations among the various markets of an economy. Therefore, macroeconomics is quite important. It is the best guide to know the significance of the study. So, therefore, macroeconomics is the study of the very important problems relating to allocation of resources, that is, whether it is to be allocated for consumer goods or capital goods, then fluctuations in the level of employment, fluctuations in the general price level, that is inflation and deflation, fluctuations in the general level of money wages, rate of growth of productive capacity, whether the resources are to be used properly to achieve the satisfactory rate of growth, the relationship between international trade and level of employment. Thus, macroeconomic studies the major issues which are faced by the country today. After having discussed the nature and the scope of macroeconomics, now we are going to discuss about the core concept of macroeconomics, which is national income.
Concept of national income. The concept of national income occupies an important place in economic theory. National income is the flow of goods and services produced in an economy over a period of 1 year. It has been defined by various writers in different ways. Pigou defines national income as that part of objective income of the community, including, of course, income derived from abroad, which can be measured in money. Simon Kuznets has defined national income as the net output of commodities and services flowing during the year from the country's productive system in the hands of ultimate consumers. The National Income Committee of India has given a simple definition, that is, national income estimate measures the volume of commodities and services turned out during a given period of time without duplication. There are a number of concepts of national income. They are GNP, that is gross national product, NNP, net national product, net national income at factor cost, net domestic product, personal income, disposable income, and real income. Gross National Product (GNP). GNP is defined as the total value of final goods and services produced by the residents of a country during a given period of time, including net income from abroad, that is, exports minus imports. The formula for GNP is domestic product plus exports minus imports. In estimating GNP, we have to consider certain factors. Firstly, only the value of final goods should be taken into account. This is to avoid the problem of double counting or multiple counting. Secondly, goods and services rendered free of charge should not be included in the calculation of GNP. For example, services rendered by a mother to her baby. Thirdly, transfer payments should not be included in GNP because they do not add to national product. For example, old age pension, unemployment insurance allowance, etc. Fourthly, capital gains and losses are not included in the calculation of GNP. Lastly, income earned through illegal activities is not included in the calculation of GNP, as it is difficult to know the year of production and they may be produced in foreign countries. Net National Product (NNP). The total value of final goods consists both consumption goods and capital goods. In modern roundabout methods of production, machinery gets worn out. This has to be replaced. Every year, a certain portion of the produce has to be kept aside for meeting such cost known as depreciation cost. This share of the GNP, which is kept aside for replacing the worn out capital equipment, is called capital consumption allowance. To arrive NNP, this capital consumption allowance should be deducted from GNP. Therefore, the formula for NNP is NNP equal to GNP minus depreciation. Personal income and disposable income. Personal income and disposable income are two concepts of national income very commonly used in advanced countries like USA. Personal income may be defined as the current incomes of persons or households from all services. It is not a measure of production. It includes all receipts from productive services and receipts for which there is no productive service rendered. Therefore, gifts, social security allowances should also be included. Similarly, people's contribution to social security like provident fund, pension funds should be deducted. Corporate income taxes have also been deducted. Therefore, the formula for personal income is national income minus corporate income taxes minus undistributed profits minus social security contribution and transfer payments. Disposable personal income. All personal income is not at the disposal of the consumer to be spent on consumption. Individuals have to pay personal direct taxes to the government. They are free to spend only after the payment of taxes. It is that part of the income which is spent on consumption. Disposable personal income is equal to personal income minus personal direct taxes. Disposable personal outlay. The disposable personal income may be spent fully or individuals may save. What remains after saving is called personal outlay. Disposable income is equal to consumption and saving. Therefore, the formula for disposable outlay is disposable income minus savings. The last concept of national income is real income. Since national income does not reveal the real state of the economy, the concept of real income has been used. To find out the real income of the economy, a base year is selected and the price of that year is assumed to be 100. Therefore, in order to estimate the national income, the following formula is used. That is, real income is equal to money income divided by price index into 100. Thank you.